This is the Retirement Solution Podcast with financial advisor Jon Hicks, founder of J. Hagan Capital.
Let's talk about the market because, and we have said over and over again, we don't have a crystal ball. You can't predict what's going to happen, but we can reflect on history. And that's something that you love doing is let's look at what's happened in the past, observe patterns, see if we can learn from those patterns up to this point. So we have seen an up market for the last 3 years in a row. We are wondering now, will 2026 make it 4 years in a row? This is the thing. That's only happened 4 times in the last 100 years. Only 4 times have we seen 3 years in a row up and a 4th year in a row up. So basically, it's an iffy. People have questions about what's going to happen with the market in 2026. 50% of retirement savers surveyed by T. Rowe Price believe that there will be a recession this year. 34% expect to keep working part-time when they retire, just in case. However, when you ask financial advisors about 2026, most believe the market's going to be up by 10% by the end of the year. So what's the disconnect happening here, John?
That's a pretty big disconnect, but we see it all the time, right? So when you kind of think about it, when most of us, and I think it may have been Warren Buffett that said this, I can't remember who exactly it was, but someone said people don't need predictions. They don't need a fortune teller. They need a game plan, right? I mean, that's what it all boils down to, because I can talk, and I have spoken to hundreds of people over the years that they're looking for the perfect plan. And you know what happens, Heather, when we are looking for perfection, it rarely
chronically
comes across.
Disappointed.
And the problem with that is that a tolerable, just a not horrible plan that you implement and stick with is better than not having one at all. That's kind of that whole thing. So, one of the things that I think causes a big disconnect is most of us, when we're consumers, we're really looking at the economy, and the idea is a gauge of our wallet. Right. That's so as an individual consumer, every time I go and I'm looking at the price of ground beef going from like $3.99 a pound just a couple years ago to then, when it went stratospheric, during COVID, and today it's over like $6 and something for ground beef. And this is like even at Sam's Club or Costco, not even the highfalutin places, right? And when you see that, you're like, oh my gosh. So, same thing with oil prices. They've come down a lot now. I was amazed as I was driving this weekend and I had to fill up. I'm like, oh my gosh, what is it? $2.48.
Nice. It's nice to see.
That's not bad.
Yeah.
But there were so many times that I did fill up where it was over $100 to fill up the tank. Yeah. And so that's those things that we're thinking, man, are things good? We typically think with our wallet. And we vote with our wallet, right? So this is also a midterm election year. Some people that like the way things are going, they're like, oh no, this could, hopefully this doesn't get all changed. And other people are going, yeah, we need some change. But the point of that is that we're going to vote based on if we're feeling the pain in the economy. So I think that's why, in even this previous week, the president came up and said, I really want to see the market doing better. I think that the market is not priced in all these great things that the administration's doing, right? He's even nervous.
That
tells me he's even worried that people are going to be voting with their pocketbooks come the fall elections for midterm elections, and it could be problematic for him.
Yeah.
So the point is that when we're always thinking about that idea of what is it costing me, most financial advisors, they're not looking at your shopping cart. They're looking at earnings reports. And to be perfectly honest, a lot of those earnings reports recently have been pretty good. The question is, can they sustain? I'm not really sure. So the big thing to understand when we're ever looking at these different lenses, most of us are thinking about what's going to happen this year. If I have a 30% hit, can I still retire? A really good advisor should be thinking, when, not if, a 30% hit happens.
Yeah.
If it happens this year, can I stress test my client to make sure they're going to be okay? If it happens 3 years from now, can that client still do that Mediterranean cruise that they talked about? If it happens later towards retirement, will they still have enough money to give to those grandkids the way they wanted? But we're typically thinking about things in 5, 10, and even 30-year time horizons as opposed to just 1 year at a time. So it is not uncommon for someone to come into my office and say, John, I just never hear from my guy. I'm like, well, is it because you think he's not good at what he's doing? Or do you think that he just thinks you're probably fine? Right. And what they typically say is, well, but I don't know if I'm fine.
Got it.
I'm like, well, we can figure that out real quick.
Yeah.
And when I show them the stress test that we do in our office, hey, what happens if interest rates go way up? What happens if interest rates go way down? What happens if the market collapses 40%? What if it goes up 20% based on what you currently hold? And you see those things, most people go, oh, wow, So if I have a 30% hit right now, it wouldn't look real good at all. But if we make a couple of those minor corrections you're talking about, not only am I fine, I can even retire a little earlier. Exactly. And so a good and skilled fiduciary advisor should be able to give all kinds of not just opinions, not just kind of insight, but help you understand your own money. They should be able to find out how much are you protected, how much income can you create, where is your tax strategy, how, if something happens to you or your spouse or your kids, where would that money go next? How do we keep it away from the government in those situations? And how would we pay for healthcare if we have a scare or if we have a bad diagnosis or whatever? Those 5 things, a good advisor should not just show you things to do, but show you how it would all work if it's implemented, right? Because that way you know, well, if you're worried about protection, you know you can't lose it all because the way you're protected in your portfolio. Why? You have hedges, you have safe assets, you have income coming from multiple sources on top of your savings and Social Security. Maybe you have an annuity that can be replaced to give you a better income for the rest of your life or even for your kids' lifetimes. Maybe you can find different tax strategies to just get an extra $40 or $50 a week in income, offsets the cell phone bill, if nothing else, to pay for things, right? So those are good things that really good holistic advisors, they should be able to do. So again, the point is not that you hire an advisor. The question is, do you have the right guy? Because sometimes it's just knowing, hey, I know that my guy does these 5 things across the entire part of my portfolio. And no matter what happens, I know how I'm protected and where my income's going to come from. So we don't do a whole bunch of forecasts in our office. Generally, I'm going to say there's one thing for certain that's going to happen this year in 2026. It's going to be up and it's going to be down. And I tend to feel that it's going to be very volatile. I don't know what that's going to look like. I don't know if we're going to see a down 30% accompanied by a 50% up. I have no idea. All that I know is that for every client that I'm talking to, I want to make sure they're protected no matter what happens. And as long as they're protected and they can keep on keeping on, there's going to be a different opportunity somewhere around the corner. That's how you know you have a good plan. When you're not worrying about headlines and you're really worried about the black lines of ink on your statements. Those are much more positive.
Yeah. I think I also heard somebody say in regards to this whole conversation about what the market will do, one, if you're worried about it, then you probably are carrying too much risk. But another person said, test your risk before the market does.
Always.
That's what was a very poignant statement to me.
If you have a standard portfolio full of mutual funds, exchange-traded funds, stocks, and bonds, you really need to look at what would a 30 to 35% downturn do to your portfolio and the time that you want to retire. If you're going to retire in the next 2 or 3 years, that may give you enough time. How much cash do you have sitting aside so you don't have to pull from those beaten up assets to get to retirement in the front end, right? So those are those parts of that stress test. They're a big deal. You know, most people, they get so worried. Oh my gosh, but what about a downturn? They don't realize if they just had the right plan, they could retire 2 or 3 years earlier, no joke, 2 or 3 years earlier than they thought and maintain a higher income. This is real. I see it happen every single week in the office where people just don't realize. They're saying, John, can I ever get retired? Or is this enough money? It's like, hey, what do you want to do? What do you want to accomplish? What is the absolute, the things you have to have? And what are some things that are negotiable? If we know that they could retire 2 years earlier and be just as happy, why would they go earlier? Because they're healthy right now. And they're younger and they can enjoy it. Well, it doesn't mean that they know exactly what they're doing next, but just knowing that, that's when we start finding out, can we get them retired earlier? Just knowing the options can make one of the biggest difference in retirement more than anything else.
So in this new year, in this year of 2026, the investment world is a little bit different because Warren Buffett has officially retired. We never thought we would see the day.
No. He's 94 years old.
I mean,
94.
Kicking.
He's been doing this. And this is what most people don't realize. Buffett started investing at the age of 10.
What was he investing in at 10? Do we know?
I have no idea how he even could. I don't know. But every time I've read his bio or whatever, it all says the same thing.
Okay.
Whether he just put his money into, I don't know. They didn't have exchange traded funds. They didn't have mutual funds back then.
Yeah.
I have no idea. But if anything that he talks about now, he did back then, he's like probably whoever made Bazooka Joe bubblegum, right? It's what he knew. He's always invested in what he knows. So it's probably Coca-Cola. I'm just making this up. And Bubblicious or Hubba Bubba. I have no idea.
Seems like something seems legit for a 10-year-old to invest
That's not bad.
And Coke and bubblegum. So the legendary investor. He's no longer CEO of Berkshire Hathaway. He's still chairman. So he's still, I mean, he's not just going to give it all up. Of course, we wouldn't expect him to. Talking about, we have shared Buffett-isms repeatedly on this radio program, Jon. Yeah. The lessons, the wisdom he's shared over his decades of a career. And many believe that these lessons, no matter how far they go back, they are still very relevant to this day. So I wanted to talk to you about some of the lessons he's shared and what you think, what your opinions are on what we as savers, as investors in 2026 can continue to learn from Mr. Buffett's investment advice and mindset.
Yeah. So, I mean, if we kind of go through the big ones, I want to go through, there's a 3 or 4 that I really want to hit on. The first one is, and this is probably, I think, I can't remember if Buffett said it, but someone did, and he has always alluded to this. Compounding interest is maybe one of the most important things in the world. As a matter of fact, I believe it was Buffett who called compound interest the 8th wonder of the world. And here's the reason why. He said, it's amazing. If you let time work for you, then unbelievable things can happen. And when you look at Buffett himself, so as of this morning, Buffett, 94 years old, is worth roughly $148 billion, Heather. Almost $150 billion.
I can't even conceive what that is.
Billion. I know. But you know what? It's crazy. Do you know that 95% of his net worth came after he turned 65 years old?
Wow.
That is not a joke. So he's 94 now, but 95% of his net worth happened after he was 65 years of age, when most other people were hanging it up, dialing it down, going, it's like, no. I've been working for the man entirely too long, even if that man is me, and I am going to have some much needed R&R. I'm going to get a fruity drink with a little umbrella in it. Or listen to some Kenny Chesney and chill. Buffett, 95% of that $148 billion was done after the age of 65. And why is that? Ladies and gentlemen, it's simple. Compound interest. All of that money that he had saved all those years prior just kept compounding and compounding and compounding and compounding. We use this simple exercise in our office every time we're talking with a new client and asking them, what are their expectations about where they are today? Where do they want to be in the next, let's say, 10 years, if they're retiring in the next 10? And then if they live a normal life expectancy, let's say 25 or 30 years down the road, what would they expect that to look like? People's eyes almost pop out of their head when they're like, Jon, I'm coming in here with you today. I've got $2 million, but you're telling me if I spend the way I want in retirement, spend the money the way that I want to spend it, keep spending, even with inflation, even with tax concerns, all of this, you're telling me that my $2 million today may be worth over $8.5 million by the time that I pass away in my mid to late 80s? That's exactly right. Why? Compound interest. And that's even after you're living out of an income and paying taxes along the way. Guys, it is amazing what you can do if you have the right type of plan. But compounding interest is the one thing that I will never forget because it's so simple, right? You put money away, you pretend it's not there anymore, you let it do its thing, which means you have to own good quality stuff. But if you do, right? And guys, it's out there everywhere. It almost doesn't matter to me within reason the companies that people use, whether it's Schwab or Vanguard or Fidelity or T. Rowe Price, doesn't make any difference. You just want to get something that fits for you, that's low cost, and it's nimble when it comes to taxation. If you do those things, it's probably a good investment. But compounding, which means you have to leave it alone and give it time to do its job. That's probably the biggest thing.
Okay.
But if we go down the list a little bit further, Heather, the other thing that I think I like more is that things that he trusts. There are some things like Coca-Cola, that he just says, I just trust it. Here's the they make a quality product and it's consistent. And he knows that. So regardless of predictions, right? He says, trust over predictions. I want to trust that that's a good management company, that they're doing the right thing for the shareholder as well as the clients or as well as the employees. And if they are, I'm going to trust that over predictions. And he's always stuck with that too, which basically means if you got something good, you don't need to change it all the time. Right. And I think that's a really good thing to look. And the last one I'm going to talk about today is keeping things simple, right? One of the
easier
biggest
said
things,
than done. Simple
I know.
easy are not aligning concepts either. Please continue.
It amazes me when you just sit an exchange traded fund beside a stock, beside a mutual fund, beside a variable annuity. Just those four things. If you set them side by side, it is amazing how similar they can perform and how unbelievably different they can all be at the exact same time. Right? And most people are like, oh, well, John, I got this fund. Sure. Is it a mutual fund, exchange traded fund? Yeah, I'm not really sure. That's how complicated it can be. But the thing about Buffett, one of his big things was he wants to keep things, even if they can get very educated, even if they can be very academic, he still wants to keep it simple. For instance, does it make sense to risk 55% of my life savings? If so, then maybe 55% or whatever the number is can go into market-based investments like Schwab or Vanguard or Fidelity or whatever. But if you cannot handle losing that principal, his idea is, well, then don't risk it. Don't risk what you can't afford to lose. And this is what I want to take just a second to keep talking about. All right. So of all the things we talked about, having compounding work for you, just make time work for you. We want to make sure that we're not always looking at predictions. We want to have trust in good quality products and advice that last the long run. But this keep it simple thing, it really comes down to just being certain that we understand what we're doing, right? And we understand about risking money. Because I see people come into the office every week, Heather, every week that have saved an unbelievable amount of money. They could retire tomorrow if they want to. They have no real major things that they need more money, but they feel like they're trained. And they tell me all the time they feel a little trapped, that they just don't know how to hang it up. They don't know how to say, hey, I got tons of money. Why am I taking all this risk? Because these same people may have 90, 95, sometimes even 100% of their money in market risk situations. Now, here's the thing. I have built my business. I have built my portfolio out of the awesome up trajectory of the U.S. markets over the past 25 years. I have. I'm a product of American capitalism and ingenuity and hard work. I truly am. And I think that we can all get that. Having said that, I haven't hit my numbers yet. My numbers don't yet say that I can hang it up and I really don't have to risk that much anymore. But every time I'm talking to people that are 3 to 5 years from retirement, Heather, they've hit the number. They're there. They can do it. And the question is, simple Buffett, keeping it simple, should you be taking that risk at this stage? It doesn't mean put it under the mattress. It doesn't mean sticking it all in an annuity. It doesn't mean put it all in the bank. I'm not talking about that. The question is, do we know how much we're risking at any given day? And are we risking more than we can afford to lose? When I think about simplicity, at the end of the day, I can get almost anyone retired within reason in a matter of years, almost anyone. The question is, can they stay retired? Do we have enough resources? Do we have enough income to allow that? Do we have enough assets in case they have healthcare concerns? But the truth is, I can get almost anyone retired. The question is, can we keep them there? And that all comes down to simplicity, right? People are worried about the delta of some fund or the stochastic index of another fund or standard DV. I'm like, guys. Simple. Do you have enough money to pay the bills? If inflation is 3 to 5% a year, can you keep up with that? And can you retire and stay retired from the day you want to start retirement until the very end, which for most of us, 25 to 30 years. If you can, then guys, you've already won. So don't take more risk than you need to take. But, of all the things that Buffett has said, those are the big three, right? Compounding, keep it simple, and make sure that you don't predict too much. Quality stuff for the long run.
Quality over quantity. And let's not forget that most famous Buffett quote, rule number 1, never lose money. Rule number 2, don't forget rule number 1. But again, simple advice. Sure. He's such a clear and simple person. And I think maybe that could be the biggest in a world of chaos and social media and never ending news cycles and streams of information. And it comes at us like this over and over again. Keeping things simple might be the biggest takeaway for all of us. So if you are ready to simplify things for yourself, at least from a financial perspective in this new year, Jon and his team, they would love to help you in that space. Let's begin the conversation. You can give us a call right now to put some time on the calendar. 502-317-0840 is the number you're dialing right now. 502-317-0840. We've got a teammate standing by off the air to answer your call, and it's going to help you set some time for an initial phone conversation with one of our advisors at J. Hagan Capital. 502-317-0840 if you're 5 to 10 years from retirement and have saved at least $500,000, that's where you're really going to see the benefits of the kind of planning Jon and his team do at J. Hagan Capital, and they're ready to show you what they can do for you. 502-317-0840. You can also go to retirementsolutionradio.com or call us right now. Let's set a time on the calendar. 502-317-0840. 'Tis the season to start talking taxes. Or maybe if you were smart and thinking ahead and you are working with somebody who's said in November or January, or November, December, before January hit, let's start talking taxes now. That was a good congratulations to you. Kudos to you.
That would have been a good time period.
Yeah. Well, and I think that for those who are already in retirement, Jon, the conversation around RMD is that, hopefully, if you're working with somebody, that conversation happened. Otherwise, you're in another boat.
Absolutely. Yeah. And they've relaxed some of the hardcore penalties on RMDs. Okay. But the amazing thing is, if we've done a good job saving, many of us, there are hundreds of thousands of dollars that need to come out annually. And if we don't plan for it correctly, we either overspend when we frankly shouldn't have, or we're just not being optimized with the things we can do with that money. RMD conversations for multimillionaires are probably one of the biggest things that we see consistently really affecting their game plan. Like, should they gift more money now? Should they give more to charities? All those things often stem with the conversation about RMDs. Are they going to need that amount of money? Do they want to be taxed on money that they don't really need, right? Yeah. So one of the biggest things that we can understand is just the proper strategies, because there's not one, there's really like dozens.
Sure.
But the proper strategies around RMD planning will make the biggest difference for this year for a lot of folks, to be honest.
So for those who did have a conversation at year's end, hopefully you talked about taxes. We're now in 2026, conversations around tax loss harvesting. And because of the upmarket we've seen so many years in a row now, might not be as big a factor as it was in previous years, but things like maxing out accounts, charitable giving, RMDs, they are still part of the picture, Jon. So for those of us thinking about taxes now, Q1, having tax meetings with the professionals that we work with, what should the conversations around these subjects or others that you think maybe are not included here that we should be having right now?
Yeah, so the tax discussion often happens exactly when we think it's not happening. So believe it or not, this beginning part of 2026, this is really not talking about the taxes that you're trying to hopefully save from last year. Sadly, that bird has already flown the coop. So 2026, the beginning of the year, you should be talking about tax strategies of how you're going to manipulate your earnings or your income or your tax favored investments over the course of this year for next year. Now, a lot of people, I just ticked you off. You're like, no, Jon, all the way up until April 15th, I can fix last year's tax bill.
What's done is done, everybody.
There are some minor things that you can do. You can contribute to an IRA. You can do things like that. But the real truth of the matter is this is where we're planning for next year's tax return. Right. So the big things I see, all right, these are the big things. So people that have done a really good job saving typically have two issues, Heather, two major ones in retirement. Because if they've done an awesome job saving, they probably have a tax issue or a potential tax issue, depending on how they work their strategy, and they probably have an RMD issue. It's just how it works, right? Because they and both of those kind of work hand in hand.
Okay.
So if you've saved millions of dollars in tax deferred accounts, and we kind of are aware of this, tax deferred accounts, we get a tax break when we put the money in most of the time, but when we pull the money out, we're going to be hit at our full marginal tax bracket. So many of us, when we were working, putting money away into our 401k and IRA, we were getting a 22% tax break or a 25% tax break on that money that we were contributing to that 401k or that IRA. Not bad. And if we were high wage earners, hopefully we got a 30% tax break or so forth. Now, in retirement, if you have done a great job saving and you're a multimillionaire, like so many people we talk to, all the listeners of the show, if you are a multimillionaire, what you're saying is, Jon, this is awesome. I've deferred all this tax. But as I'm looking at it, I'm going to have a $227,000 RMD starting in a couple years. And I'm like, congratulations. Welcome to being successful. Yep. This is what the United States
kicks
this is
you
that,
right
all
in
of
the
that
pants.
capitalism, right? That capitalism out the yang, and then you get kicked right in the backside when this stuff happens. So it's great that we've watched this money explode over the years, and we did get a break. But think about that for a minute. So we put money in, let's say we put in $10,000 over the years, and we were in the, let's just simple math, we were in the 25% tax bracket. So we put in $10,000, we get a $2,500 tax break. Okay, not terrible, better than paying full taxes. But as we pull that money out, let's say that you've been putting that money in for the last 30 or 40 or 50 years that you were working. That first $10,000 you put in may be worth almost like $700,000. This is not a joke. I was just witnessing this a couple weeks ago when I was sitting down with someone. Yeah, they got really lucky. They put money in. They got a good mutual fund that owned Apple and Google, all that stuff.
Yeah.
And so that first like 10, maybe it was 15,000, but it turned into almost $700,000. Wow. So it was all in an IRA, and they were going to be turning 73 next year. So we were a couple years ago when we were going through this. And as we looked through this, what we realized is they were going to have to take out, Heather. How much do you think that they were supposed to take out? So they were just going to be turning 73. Let's say they got $1 million in this account. How much money do you think they have to pull out to satisfy the RMD, required minimum distribution?
I mean, $100 million. So what? 50?
It's roughly 4% in the beginning.
Okay,
right?
So it's $1 million.
So they're going to take out 40,000.
Yeah.
Yep. That that plus their Social Security income, some dividend income, and he had an annuity that was going to be kicking on, I think at age 70, so it had already started kicking in. That was going to put them in the 28% bracket. So this is where insult meets injury, right? So they got a $2,500 tax break to put this money in. It was worth multitudes more than that $10,000. But now that they're going to pull that money out on that first year of RMD, they're going to pay nearly $8,000 in taxes on $2,500 tax break.
Look at this awesome tax break you got.
I know. And we see that happen all the time. Yeah. So if you've done a great, because here's what I see happen all the time. Someone goes, John, I'm great. I'm good to go, man. You know, I've got like $5 million, my IRAs, I'm good to go. And when we start looking at the tax aspect, they're like, oh my gosh, maybe I'm not good to go. How come my CPA didn't talk about this? I'm like, well, at this stage of the game, there's not a whole lot your CPA can really do in your situation, because like you've saved the money, you got the tax break. Now you got to pull it out. You didn't spend it down. You didn't, what I call diffusing the tax time bomb. You just let it keep compounding. And now you're going to pay those rates forever. Now, here's my question. If we expect tax rates to go lower in the future, then we would let that money keep compounding. But guys, what do you think? Do you think that we're in a good tax situation now, or do you think it's going to be worse in the future? Because that's what I kind of think. Yeah. When you got nearly, if not over, and who knows the real numbers, but around $40 trillion of national debt, and we're still running deficits in the ordinary year on our budget, guys, I think the tax rates are going to be terrible in the future. So the question is, what are your game plan? If you're always going to be in a high tax bracket, 25, 28, 32, 38 plus whatever it grows to, do you need to dismantle that tax time bomb? The answer is yes. That was a rhetorical question. If you're a millionaire, believe me, mo money, mo problems. We need to find out, how do you keep mo of that money in your pocket and out of the government? So here's what that typically deals with. We have to use it bracket bumping. We may want to understand our marginal gap when it comes down to our marginal tax rates. We have to understand RMD restructuring and, frankly, dismantling tax deferred accounts. Those are all strategies that we use in our office so that we can understand, hey, is there a way to effectively game the system so we can spend the least amount of money in taxes, maybe not just this year, but over the next 5 or 6 years as we dismantle all of those tax obligations to the government and do it cheaper than we expect to happen in the future. So Heather, when we actually do this, and we use this through either charitable donation planning, trust structures, RMD structured planning, dismantling, or asset shifting, when we look at all these things, the average bear can save hundreds of thousands of dollars in taxes over what we expect to be their normal lifetime, right? And if you've got multi-million dollars, multi-millions, 5, 6, 7, 8 million, that's mostly in tax deferred accounts, there are so many strategies you need to consider. Doesn't mean you do them. Doesn't mean any of them are perfect. It's not like a product you buy. It's a strategy. But if you utilize these guys, it may be millions of dollars you're saving the next generation or a surviving spouse or whatever it is. That's your money that you worked for. Why on earth would you want to give it up? And people do it, frankly, just because they don't know the difference. They assume they're good because they get $5 million in their IRA. Hey, John, I'm good. more power. Love it. I hope you are good. But if you don't know those strategies, or your CPA has said, I don't know if that's right for you, just do the math. Believe me, I know it's a 4-letter word, but so is fine. If you ask anyone how they're doing and their word is fine, that's not really what
they're
they want to say.
probably not fine.
They want to say, today and this week has been a dumpster fire. I cannot believe that I even bothered to wake up this morning. That's what fine. Same thing for math for most people. The difference is, if we understand how that math works best for you, you can exploit it. And that's one of those times when the word exploit is not a bad word. It's good. We want to utilize the laws, the way they're written, to put yourself in the best situation you can. And with most people, when it comes to tax planning, it's a choice. Our CPAs and our tax attorneys that we have on staff, they're simply just looking at the situation saying, hey, we can do these 8 or 9 things.
Okay.
Any of them you like? Oh, I like this one and this one. What about those? Not really my thing, or I don't understand it, or that seems complicated. No problem. Don't use them. But you always want to make sure you have the exposure, because over time, and this happens to me, right? Happens with everyone. But over time, you're like, oh my gosh, they did say that a year and a half ago. I just didn't understand what they were talking about. Oh my gosh, I should have done that. The point is, it's never the wrong time to make a great decision. So if you don't know how to exploit or to use this current tax code in your favor at the beginning of this year, give yourself this whole year to make it up for what you should have done last year. But I'd start now. If you want a second opinion on how you can make your tax structure the best part of 2026, give us a call.
That number you're dialing is 502-317-0840. 502-317-0840. We've got a teammate standing by off the air, ready to answer your call and help you set a time on the calendar for an initial phone conversation with one of our advisors. This is a no fee, no obligation initial step in the planning process. Just a space where you can ask some questions. We'll share some ideas on answers and ways we might be able to help you with your retirement savings plan. 502-317-0840. If you're over 59 and have saved at least $500,000, that's where you're really going to see the power of this kind of planning take effect. John and his team want to show you what they can do for you, what opportunities you might have for the years ahead. You can also find us anytime at retirementsolutionradio.com, or it's 502-317-0840.
New watch will tell me how many steps I've taken today. 47. No wonder I'm tired. As far as social media goes, you can follow me on the bulletin board at Kroger's or my chart. Because of my bad back, I've had several MRIs, and it's been determined that I have thin bones. And as it happens, Thin Bones is also my gangster name.
Oh, it's good to laugh a little bit when a lot of other news is making us not do that. That's Andy Huggins. He is 74 years old. He has been a stand-up comedian for 46 years, and the "you can follow me on my chart" moment is so real. As a middle-aged woman, I feel like I spend more time on my chart these days than I do on any social media platform. You
know, it's funny. In my 30s and early 40s, I don't think I even knew how to log on to my chart.
Right.
For real. I'm just like, listen, if it's not going to kill me, I probably don't even need to know about it anyway. Drink a little less, eat a little less, and move a little more. But it's amazing over the past several years. It's kind of like, let's take a look at here. Am I on blood pressure medicine? How much am I taking? Is that a good amount? Is that a bad amount? Okie doke.
Yep.
I know.
It's that way. It's very real. It's a real little dose of reality. Mr. Huggins presented to us, and the gangster name Thin Bones.
Thin Bones.
It's another space. It's another space we all exist in. No, I just appreciated his sentiment, because I was thinking, gosh, at 74 years old, he's still performing. He's not just working. The life on the road is a strenuous one. So he can make jokes, but he's obviously taken care of himself and done some things right.
Absolutely. I mean, with 74, that's for real. I mean, I remember when we interviewed Catherine McPhee and David Foster. And, it's crazy because David,
isn't he?
He's maybe early 70s. Well, it's been a few years since I've seen him. But he was great. And his whole point was they had a 3-year-old running around behind 76, a 3-year-old running around behind stage. Yeah. And I'm like, David, dude, how do you do that? He goes, it's what keeps me young.
Yep.
For real.
Keeps them moving.
He said, because to get up here and to be on the road, to go from Nashville to Kansas City to every places they were going, It was crazy. But I mean, you have to be in a certain frame of mind, right, in order for that age to not matter as much.
I agree.
More power to
keeping yourself young, keeping yourself young, whatever way possible. As I was saying, because I wanted to start off with some laughs, because some of the headlines that we continue to get, not some of them, the headlines we continue to get can be a little stressful. But also another thing that we work to do here on this radio program every week is enlighten you with some information, remind you that you do have options, empower you with what those options might be, and of course always give you the opportunity to meet with Jon and his team. The beauty of a local independent financial advisory firm, offices right here in Louisville. Jon and his team are here to help. Let's talk about some of the things we're continuing to see in this new year, because in 2026, several economic hurdles continue to come at us. One, there's a record number of baby boomers continuing to retire. Elevated prices remain straining household budgets, whether you're a young family or you're a retired couple. We're all feeling the grocery prices. There continues to be uncertainty around Social Security. That's not improving. But rather than hoping for the best, smart savers, a la you listening to us on The Retirement Solution right here today on HAS, taking action, taking proactive steps. So I want to talk about what you think some proactive steps are that we should be looking at to strengthen our retirement savings despite economic uncertainty in 2026.
Sure. Yeah, so if you kind of think about it, there's a lot of things out there that we can't control. Right. And it doesn't do any good to be worried all the time. What we really just need is a true game plan. And here's the thing. In our office, we prepare for what if things go good? What if they go gangbusters good? What if they go bad? What if they go really bad? And then what happens if it's just kind of a bunch of ups and downs that equate to nothing? Are we in, number one, the right spot for that client? But then number two, are we doing the right things to take advantage of opportunities, right? In protectionary moments. It's funny. I grew up outside of Owensboro, Kentucky, in a farming community. So most everyone around me either worked for manufacturing companies or they were farmers. And I remember thinking, it's just, talking to a farmer and, when the crops have already been harvested and it's the winter months and there's no crops to do, he's like, hey, just because it's dormant doesn't mean there's not stuff to do here. Just because it's not a time to grow something doesn't mean this is where we got to sharpen all of the tools. This is where we got to make sure the carburetor works in the tractors. This is where we get all these things to go on under the hood. So regardless of what's going to be thrown at us this year, is it a good time to just make sure that all your tools are sharp, right? Everything is ready to go. That's because it may not be the harvest. Yeah. It may not be harvest time yet. That's where you make the money, but can we do the groundwork so that we can make either an easier year for ourselves or not? So here's the things to think about. Coming into a new year, I think there's absolutely a very good shot that we're going to have a down 20 to 25% moment at some portion of this year. Okay. And it's not for any other reason that it's probably due. It's about time. If you look at the companies that led the market up this past year, they're almost all technology. Mm-hmm. They're almost every single one of them AI focused. And there have been so many billions and trillions of dollars thrown in that industry. The question is, was it worth the prices paid or the prices that are currently going for it? I don't know that answer, but I'm just saying this is a good reason why all of a sudden institutions and hedge funds and the smartest people out there are going to start going, is it really worth 80 times what that company earned last year to buy a share of its stock? Is it really worth it? And if they say, maybe not, that's when downturns happen. Essentially, there were 9 companies that led everything that last year, and those same 9 companies look to be leading this year. It's easy for all of a sudden the market to get a little bit disenfranchised with the same 9 people, right? Yeah. It's just like anything. You have the same actor is always up for, actor of the year, and everyone gets so excited when there's a newbie. Mm-hmm. Finally, someone new. Mm-hmm. Russell Crowe is not at the very top of the food chains, or Mel Gibson, and that breaks way to whatever. There's a handful that stay in there forever. The Tom Cruises, but realistically, there's just a lot of maneuvering around. So what can we make sure that we understand and put in place? Protection and income. Those are the 2 things we can do no matter what. And here's what I mean by protection. How are you protected? How much money is market-based? How much money do you have in technology? How much of a buffer or a barrier to the downturn do you have? Do you have hedges? Do you use derivatives to control your downside? Can you make money on some parts of your portfolio even if the market goes down? Do you have insurance against losses? You can actually get that. You can even do it with CDs, believe it or not. You can buy certificates of deposit offered by banks that give you some portion of the market upside, but guarantee that you can't lose anything on the downside if it's underwritten by a proper bank. Right? Those are real. Those exist. Those are called market link CDs. So to me, it never really matters the product that someone uses. The question is, what are the things you've put in place to protect you from the downside? Okay. Because again, the things that we can't control, all the negative headlines, I think this is going to be a really up and down year. I mean, this week we're talking about everything going on in the Middle East. I'm still talking about things going on in Ukraine and Russia, still talking about, the Venezuelan, I guess the getting out the dictator in Venezuela, and the world is still talking about that. And next week, we go into Davos, which is where the entire world's financial leaders get together in Switzerland and try to figure out what are ways that we can actually enhance ourselves or make sure that bad players don't keep dominating the headlines, right? All of those things we can't control, but we can control the risk that we have in our portfolios and the income we can generate. Those are the things that we really want to focus on. So how can we get more money to use? Well, that's one of the big changes this year. If you are 50 plus, we can put a lot more money, catch-up contributions into our 401k. As a matter of fact, they've actually moved those up across the board. So if we kind of look at those, and Heather, I'm pulling it up right now. Yeah. So you can put up to $24,500 into your 401k at work. That's a lot. Yeah. Here's the crazy thing. If you're between 60 and 63, Heather, you can put in another $11,250. So we're talking nearly $36,000 we can put away and not have to worry about taxation on that money, but that's money we can use for retirement. Now, one of the major changes they did this year is if we're going to do a catch-up contribution, so this means we're over 50, if you have income over $150,000, all of that extra catch-up money you put in, Heather, has to go into a Roth IRA. It's interesting. Now, why are they doing that? Well, frankly, I've talked about it all the time. The government's kind of broke. They kind of need the money. So if you're going to put extra money away, they're going to encourage us by allowing us to do it, but they want the tax money now. Now, in my opinion, that's not a bad thing, because that money, if it goes into the Roth portion of your 401k, or if you roll it into an IRA, you will pay no taxes in the future on all the growth, assuming you pull it out correctly.
Some higher earners traditionally have been limited on what Roth options they might have, right?
If they made too much money, they couldn't even put money into a Roth.
So this isn't necessarily a bad thing.
I think it's a good thing.
Okay.
So I think I want people, because that's a good thing that we can do right now. Yeah. Again, the government's nearly $40 trillion in debt. They're gonna have to start taking money from some more of us, whichever portion of it, corporations, individuals, people that are worth more than $1 million, people that have more than $100,000 of income in retirement. I've heard them all saying that they could tax every one of those groups differently, right? No one knows. Right. But the main thing is, what can we do now? It doesn't mean you hide. You don't stick your head in the sand. Just protect yourself. Understand, am I protecting my assets? Am I protecting my income? Or am I protecting my after-tax spendable money? All those three things need protection. And here's the thing, guys. No one knows what the market's going to do. But everything that we're talking about today is good, whether the market goes through the roof or unfortunately it goes down through the ground. It makes zero difference. Those are all three things we can do and we can control.
Let's begin the conversation helping you understand about your plan, your money, your future. It's retirementsolutionshow.com, or just click on the links we've got posted in the show notes.
Thanks for listening to the Retirement Solution Podcast with Jon Hicks. Begin the conversation about your savings plan with Jon and the team at J. Hagan Capital by visiting retirementsolutionradio.com. Be sure to listen to Jon's radio show, The Retirement Solution, Saturdays at 8 a.m. and Sundays at 9 a.m. on News Radio 840 WHAS.
J. Hagan Capital Incorporated is not licensed in all 50 states. To find out if J. Hagan Capital Incorporated is licensed in your state, please call 502-690-5635. J. Hagan Capital Incorporated is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. By contacting us, you may be provided with information about insurance and annuity products offered through J. Hagan Capital, LLC, NPN number 1882794.